What is going on, DeRosa Insiders family? This is Matt Faircloth, and welcome to DeRosa Insiders Live. My name is Matt Faircloth. I'm here from the DeRosa Group, here to talk to you about all things multifamily, all things real estate investing, all things cash flow, all things alternative wealth. Let's get into all the things, right? This is DeRosa Insiders Live, and if you guys are not a member of our DeRosa Insiders community on Facebook, do yourself the favor of going to Facebook.com. You guys might have heard of that website, Facebook.com, and join DeRosa Insiders, DeRosa, DeRosa Insiders, which is a free, capital F free community that you guys can join. That we talk all kinds of real estate shop, all kinds of things about real estate investing on that community. Get on there and join. That's where all the cool kids are. We'll see you there, right? Guys, we've got a really exciting show for you guys today. We're going to be highlighting just people invest in real estate for different reasons, that be that wealth preservation, cash flow, just building alternative source of wealth, and not just everybody linked to the roulette wheel of Wall Street for building their wealth, maybe building their wealth in other places. But some people also invest in real estate for the tax advantages. Today, we're going to talk about taxes and how you can get advantages over those taxes and pay a little bit less in taxes. Because, hey, guys, it's not how much money you make, it's how much you get to keep. So we're going to talk about that today with our awesome guest. So stay tuned for that. If you guys want to hear more about how DeRosa can help you, whether that is through one of our free, capital F free webinars, or through our very, what I think to be conservatively priced for you, and it's a great price for you guys to benefit from, our accelerator program, which is under a brand new price point now. Now, y'all can pay monthly. It's like a gym membership. Pay, and when you've gotten enough, when you're big and beefy with all your real estate muscles, you can move on down the road. But you can just pay us monthly for our real estate education programs by going to DeRosaGroup.com/accelerator, DeRosaGroup.com/accelerator, guys. Go check that out. And we want to hear from you guys. We do monthly free webinars. We teach all kinds of free stuff. I just keep saying free. You know why? Because it's free. And we have lots of free education programs that are out there for you guys to check out, including monthly webinars teaching you guys all kinds of cool stuff. My man Hervé Francois is going to be leading one for you guys next month, in the month of October, which is when the next free one's coming up. See you guys there. Now, let's hop in to our current event of the day. Folks, multifamily pricing, right? People are all like, multifamily pricing, there's going to be blood in the streets. Multifamily pricing is going to drop, fall off the map, whatever it is. Well, I'm not saying there's blood in the streets. The streets look pretty clean to me, but multifamily pricing is certainly down about 8.4% based on what it was a year ago. So there is a strong theory, which I am a subscriber of, that the high watermark for multifamily pricing was around a year ago, right around 2023. Let's say Q2 2023 was when prices were about as high as they would go. People forget something, right? And I remember this from 2008. I remember this from all kinds of other real estate markets that have happened. Real estate is like a really long tail for the finance market. That's the dog wagging over here, right? Yes, interest rates went up a while ago, right? Not last week. A while ago, they went up. Real estate tends to respond in sometimes, guys, up to 3 quarters, sometimes even 4 quarters beyond an action that happens in the finance world, right? Rates went up, and then we're now starting to see the effects of that. Rates go up, and you're not going to see housing prices drop. You're not going to see housing prices fall off, or multifamily prices or multifamily sales volume drop immediately. Things have to work their way through. The python's got to swallow the pig one bite at a time, and it's got to work its way through, so to speak. Okay. And what's happening, I believe, is that the effects of things that happened in the finance world a year ago, even more than that, are now starting to show their head in real estate, which today what we're going to talk about that I want to highlight for you guys is real estate multifamily pricing. And I'm like, this article talks about larger multifamily, like, REIT level stuff and whatnot. But I've seen REIT transactions down, and I've also seen smaller mid-sized multifamily or even really small multifamily transactions drop down, and also prices come down a little bit. So we're looking at an 8.4% price drop. But guys, that may be what you need. So for those of you that are sitting on your hands, that are sitting here waiting for things to start to begin to make sense, I would get out there. We at DeRosa have seen sellers asking this for properties, but guess what? We've called the broker like, we can't get anywhere near that. Great. And we've submitted offers, and we found that sellers are getting realistic because offers are not coming in anymore at or above what their asking price is for good assets, right? So my suggestion to you guys, I tell this to our students in our accelerator program as well, that get out there, make offers. Okay. Before you get out there and make offers, though, pick a market. Right? A market, not 10 markets, not 7 markets, not 4 markets. And also a state is not a market. So pick a market inside of a state that you like, that you want to invest in, and get out there, get to meet brokers. And guess what? If you find that the broker's got a property that's overpriced, make an offer. Things are starting to change in the market. 8.4% is nothing to sneeze at. It ain't 30%. It's not 50%. It's not, those numbers are not going to happen. Multifamily is there's just too many eyes. It's too foundational of an investment class. Too much big money is dependent upon multifamily to be successful, including the government has money involved in multifamily through Fannie and Freddie, right? So you're not going to see multifamily, get cut in half, as you may see other asset classes that have that happen too. 8.4 is very significant. I believe right now is the time to get in. Are we at the bottom? Maybe, maybe not. If we're not at the bottom right now, we can certainly see the bottom from where we're standing. I think multifamily is only going to go up over the next couple of quarters, being that it's at 8.4 down from where it was a year ago. So I believe that now's the time to get in, to consider multifamily as an asset class you might want to invest in. Check out the link below that we just posted here on our live feed, and we'll make sure to put that link in the article for you guys to check out on the data on multifamily being down 8.4% year over year. That's significant, guys. And there's some real data on some real REITs that are still active, but maybe it's time for you to get active too. Okay, join the REITs, join the cool kids, get in there, pick a market, and get out in there, start making offers, and be a part of what I think to be a somewhat corrected market. Okay. Guys, that's I want to now change gears and talk to you guys about our guest for the day and what we're going to talk about. I said before in the intro to this show, if you guys missed it, I'll say it again. Why do people invest in real estate, right? People invest in real estate not just because it's cool, not because it's fun. It is cool and it's fun, but people invest in real estate for certain reasons. And if you're raising capital as we do, it's important to know why your investors are investing with you in a deal or in real estate in general. As I said before, they invest for very specific reasons in real estate, be that cash flow, right? It's an investment vehicle that if structured properly can pay a monthly, quarterly check back to you as a portion of, it should do that, to pay a portion of revenue that it makes back to its owner as a cash flow revenue stream. Okay. That's one reason why people invest, is because they want that cash flow that real estate can produce. Okay. There's another reason why people invest in real estate is to preserve their wealth. Maybe they've been blessed and lucky enough to have a little bit of a nest egg or a big nest egg set aside. Real estate's one of the best places to keep your wealth. Did you guys know that a oversized amount of millionaires, I wish I knew the percentage off the top of my head, but a oversized percentage of millionaires in the United States either made or hold their wealth currently in real estate? That is a huge portion of millionaires in the US that either made it in real estate or are now keeping it in real estate as a place to keep and grow their wealth. So that's another reason why people invest in real estate. But today, guys, we're going to talk about legal ways that you can minimize your tax burden through real estate investing through something called a cost segregation study. So guys, let's bring in our guest, Mr. Sean Graham. Sean, how are you today? Welcome to the Cash Flow Diet. Welcome to DeRosa Insiders Live.
Yeah, how are you doing, Matt?
I'm good, man. How are you?
I'm good. Thanks for having me on here. I'm super pumped to be here. I was thinking about it, and you have the raising private capital sign in the background. I've got a note on my phone, my iPhone, from 2019 of like details of the entire book that I went through. That's how I kind of started out in real estate, and it's cool to actually be talking to you in person here.
Well, you're welcome. And I'm glad the book made an impact for you. As it has for a lot of people, I had no idea that book was going to do what it did, or that so many people were going to reach for it when they were learning how to get involved in real estate investing. So, but I'm grateful to have you here today. Your company is called Maven Cost Segregation, or Maven Cost Seg, correct?
Maven Cost Seg. Yep.
Maven Cost Seg. Okay. So tell us real quick, guys, and then for listeners, we're going to talk about tax advantages, right? And a cost segregation study is one of the best ways to leverage tax savings from real estate investing. So Sean, could you real quick talk our listeners through what why real estate investing is a place that people should look for tax? And we'll unpack cost seg in a second here, but let's start with just tax savings first. Why is real estate a good tax shelter for people to invest?
Yeah, I think, if you look at all of the very wealthy real estate investors, they don't pay anybody any taxes, right? And the reason really is because of depreciation. So the IRS, they incentivize people to invest in real estate, keep improving real estate, keep reinvesting in real estate. And there are tax advantages to that, so that really the taxes are all deferred. So we can front load appreciation, we can offset the real estate income, we can offset other passive income as well. And the IRS just loves real estate. So I think it's a great way to build wealth, to build equity, to build cash flow as well, and to keep that cash flow in-house and have minimal taxes. So I think there's a reason that the wealthiest people are always investing in real estate, and a lot of that is for tax purposes too.
Yeah. There's one of the reasons why the IRS, I think, loves real estate is that they understand that real estate ownership, it's not like, back in the medieval times of like lords and stuff like that. Well, it's really there because the IRS understands that owners of real estate provide opportunities for others, and they provide, be that housing or opportunities for somebody to open up a business. The only way I'm going to make money with my real estate is if I make it marketable, affordable, and something the market would want to use, be that a storefront, an office building, or an apartment building, whatever it is. I think the IRS is forward thinking enough to understand that that's why we get benefits of depreciation, is because real estate is a asset that benefits society. In some ways, it's tough to find other asset classes that benefit society as much as real estate does.
Yeah, I agree. It's the foundation of the economy, really.
Yeah.
Businesses where people live, it's all real estate is heavily factored in to all of that. Obviously, we have, there's a big movement towards online businesses as well, but you need to go to any doctor or go to the dentist, or you go to a restaurant. Real estate is very, very much the foundation.
Yeah. And we keep preaching to the choir too. Real estate also provides a lot of jobs, either in the building of it, and also in the maintenance of it, and also in the economic maintenance of it. I mean, there are accountants and there are firms that help people maintain the economic status of our real estate. There are those that work for the insurance companies that insure our buildings, just in case, God forbid, something happens to them or something like that. Real estate in all the different ways is a major contributor to the economy for existing buildings, new builds, and also businesses that occupy them. So I think for all those reasons, that's why the IRS offers, I think, to be very favorable incentives for real estate ownership. So guys, that in essence, Sean, what that means is I own a apartment building, and I can by right depreciate that building. To talk me through what that, like how we structure that, what people can expect through just standard depreciation, and then we'll get into how cost seg even accelerates that.
Yeah. So when the IRS looks at real estate as a depreciable asset, so the land is not depreciable, right? So you have let's just say you have a $1 million purchase price. You have maybe $200,000 that goes towards the value of the land. You have $800,000, and so IRS says, well, there's wear and tear every single year, even though in reality, a lot of times, most of the time, right, like over a long period of time, the value of your building is actually going up, or you can add value, you can force appreciation. But the IRS says, well, it depreciates over wear and tear. And so they take, if it's residential, meaning like people are living there, it's an apartment complex or it's a single family rental, you'd appreciate that over 27 and a half years, just straight line, flat depreciation. And 27 and a half years, that's a long time, right? Most people aren't holding buildings even 27 and a half years. They're going to get rid of them before then. So what a cost segregation does is it allows you to front load that depreciation. So we say, we go into a building and we say like, okay, well, this entire thing isn't going to depreciate over 27 and a half years. There's certain aspects of it where we will depreciate some of this over 15 years, some of it over 7 years, some of it over 5 years. And so the goal, right, overall is to front load as much as we can depreciation wise to get those benefits in year one. Reason
That's
being,
because many things in my property, like I said, I wish my refrigerators and all my apartments would all last 27 and a half years, but they
right?
won't.
They're not.
Even if I put a brand new one, put a brand new one in there, even in my home, it's not going to last me 27 and a half years. And I'll treat it really well. I'm not going to abuse it like my tenants might, I'm going to, I'm going to keep it and everything like that, but it's still not going to last very long, right? It's because it's a fixture. But even
Yep.
going even further, if I buy an apartment building that's got a roof that's reached half of its useful life, that roof may need to be replaced in 10 years, 15 years, right? The wiring in the walls, the HVAC machines, the windows, all those things are all things that have less than 27 and a half years of a useful life.
Exactly.
Right. So the cost seg study is there to, like, in essence, look at the things in my building and kind of figure out what's going to not live for 27 and a half years. And
Yep.
you had said the shorter lifespans that the IRS allows us to consider for these studies are what now? 5,
7, 15-year life. And then the rest would go into
7, and
27.
15-year life. So guys, think about that. When you're looking around an apartment building, or even just like, I'll give you guys all our listeners homework, right? Walk around your home, right? Walk around your home and look at each thing and say, is that going to live for 27 and a half years? Or would that live for 5, 7, or 15, right? And start thinking that way. And if it was an apartment building, the IRS would allow you to put these things on into a different bucket, because they acknowledge, they realize, they're realists as well, that yeah, we can't write everything down over 27 and a half years. So this idea of compartmentalizing the fixtures in your property into different lists, that's been going on for a long time. But there's a new feature called, as Sean was talking to about, us being able to realize some of those losses now. So Sean, talk to me about it. So now I've got my list. I got all my fridges and my maybe my plumbing. Maybe it actually helped me list a few other things that people like. What's like the most uncommon thing that people don't realize should be on that 5, 7, and 15-year list? Like, what are some things people might think, oh no, that's certainly a 27 and a half year life thing, but surprise me. Give me something that should be on the short list.
For sure. So, let's look at, I guess, starting with first of all, let's start with land. The land is not depreciable.
Yeah.
So we have
Your
to
building
extract
burns to
value.
the ground, you still got the ground that it was sitting on.
Exactly.
Right.
Exactly.
Yeah.
The earth's not going anywhere. So
Yeah.
land is not depreciable. Then the
Yeah.
next thing is
Unfortunately.
you have the building. And so the building, the actual structure, I like to think of it as really like the structural components. So you're talking about like the foundation, the brick walls, the roof, like what actually makes it a building, right? Even like the windows, all those, that is part of the permanent structure of the building. That all still goes to 27 and a half years.
Mm-hmm.
It's the things underneath that we can go into 15-year or 7-year or 5-year life class. So working our way down, like we're talking about exterior
Yeah.
improvements. So sidewalks, fencing, maybe you get a new patio,
Sidewalks. Okay.
landscaping,
Yeah.
driveways, all those things. Those are like exterior land improvements, site improvements. So all of those, they get to go into that 15-year life class. Yep.
Okay. Okay.
Seven,
What about like sheetrock? What about like the the walls of my property, am I allowed to, am I lucky enough to get to put that on a 15-year list? I'm not like quizzing you. I'm actually curious. Now you got my curiosity sparking.
Yeah, yeah, no,
Because I've always wondered that, like things like sheetrock and insulation, does that get to go on a short list or is that on the long list?
that's going to be on the long list. Yep, that's
Well,
going to be 27.5 years.
okay,
So,
makes sense.
yep,
Makes
yep,
sense.
because it's permanent. It's part of the
Yeah, it is.
actual structural structure of the building. So there, it gets
Bet you my
kind of
kitchen
weird.
cabinets. Bet you my kitchen cabinets don't have to be on the long
Nope,
list because I'm
those are
certainly going to
5 years.
take those out.
There you go. Those are
Yeah,
5 years. So
5
7 years
years.
more like furniture. Like if
All
you
right, of
bought a short-term rental and it had like furniture in it and it was part of
course.
it, that's going towards 7 year.
Yeah,
5 year, we're talking like kitchen cabinets, kitchen appliances, the kitchen drawers, maybe the laundry, garbage disposal, the electrical, right? The electrical is permanent, but we actually the engineers actually break down the electrical into what is going towards the like the garbage disposal or towards the maybe the laundry, right? And we're
mhm.
able to actually extract some of that into the 5 year life class. So we can get very, very granular.
And here's a note to all the listeners: don't you ever put a garbage disposal in a rental property, okay? Um, I
It's
know
true.
that the hard way, Sean. That
It's true.
unfortunately, it's just one of these things. It's a clog waiting to happen. I mean, it's a very convenient device. It's very loud. It's somewhat unsafe as well if you think about what it is and everything like that. But I've had too many garbage disposals end up clogging plumbing lines and that because of just too much stuff getting put down there. So all
Yep.
joking aside. Okay, so I've got these lists now. So talk me through because that's like one half of the cost seg study of segregating these costs into these
Right.
separate lists. Then
Yep.
what?
So there's bonus depreciation too, right? So we're saying, okay, not everything goes into 27.5 years. Some of it's now we can depreciate over 5 years, right? But the IRS, through the Tax Cuts and Jobs Act, right, which was 2017, end of 2017, they implemented bonus depreciation where for 2018 through 2022, 100% of the components that were less than 20-year life, so the 15-year life, we could depreciate all that out in year one. That's slowly like fading away, but it's
Hmm.
still for 2024, it's still 60%. So
Hmm.
let's just say, $100,000 we're able to allocate towards 5 year life. Well, out of that 60,000, we can just expense in year one. The other 40,000 we expense over 5 years. Um, and I think even as this starts to fade a little bit, like there's still so much benefit in the cost segregation because you are getting this bonus of allocating everything towards 15-year life so much quicker and so much more. You get so much more of a deduction expense
Hmm.
when you are depreciating over
I
5 years
mean,
versus
I
27 and
can
a half.
tell you, Sean, because I was in, we were a part of the ramp up that happened after that Jobs Act of 2017 in our company and
Yep.
all that. And it's kind of sort of threw a little bit of kerosene onto the campfire, so to speak, because an asset, and I saw other people doing this. We didn't do this, but other people were buying assets really strictly for the cost seg that they were getting, which
Right.
I don't ever want to buy an asset. I want to buy an asset because it makes me money. I don't ever buy an
Exactly. Yep.
asset just because I can tell on paper the IRS I lost money. I mean, that's one
Yep.
half of the equation, but you also got to make money at some point, right? And so I think that it's fine. Not that it was a great run that to be able to accelerate, I believe, the 15, the 7, and the 5 year
Yes.
lists. Back in the heyday, we were able to push all those up to year one, which means if you buy an apartment building, you could be lucky enough to depreciate 50% or more of that purchase price on the asset first year. Pretty cool.
It's very cool. It's an
Yeah,
amazing tool. And there's still a lot
it
of
is.
that benefit left. Yep.
There is. And now you can go 60% now and 40% after. But what I don't want people to lose sight of is to say, oh, well, okay, now it's 40, so the juice isn't as good or whatever. A 40%, being able to accelerate 40% of that list is fine. But what it'll enable, but you guys have to remember, it's the other half of the equation. There's still that 60% that's going to allow you to write, you could take that as 60% and write off the 5 year over the next 5 years. It's not like that tax loss goes away. Yes, it's not all in year one, but the tax loss is what it is. You can just, instead of accelerating it all as a bonus into the first year, you can spread it out over the next 5 for the 5-year losses and over the next 7 and whatnot. So it maybe incentivizes long-term real estate holding, because then you're not like, you don't like exhaust all your losses in the first year. Doing a cost segregation engineering study is still imperative, I think, for anyone to do, so that they can, maybe spread the losses out and enjoy those negative K1s for a little bit longer than the first year.
Yep. No, I totally agree. And then the other thing, right? Like you're raising money, you're raising capital, and so the people who invest with you, right? You can pass those depreciation losses on to your investors. Like it's all in the operating agreement, how you set it up and everything. But that can be a very big benefit. And if you take it to another level, right? Like not everybody who's investing with you needs those depreciation losses. Maybe they're in a tax deferred retirement account, and they're not paying taxes on it anyways. So because it's staying in that tax vehicle.
You're in a tax bubble. It's
Right.
like, I've always joked that like buying an apartment building with a major cost seg in an IRA is like putting a tax bubble inside of a tax bubble. You don't
Exactly.
need both. You only need one of them.
Exactly. Yep.
Yeah.
So there's a lot of benefit to it. I think I agree with you. Don't let the tail wag the dog. Need to be invest in proper and like good asset classes, good investments, as first and foremost. But this definitely helps from a cash flow perspective. I personally, right, like I invest in real estate myself. I'm looking for great properties that can cash flow on their own. They're going to build equity on their own, and then the tax deferments, right, through depreciation. This is just a bonus. It's an add-on. But it's also very real. So something that people, if they need, right, if they need to look at it ahead of time, they're interested in this, we can actually do the estimates for them ahead of time. And so it won't be exact, but we can get them a decent estimate to say like, okay, well, like we expect this much of a deduction in year 1 for you from depreciation. So that's also helpful to understand when you're underwriting, you're doing your due diligence to know what that would look like.
Yeah, and that's great to know, guys. To consider that Sean's company will do that. If you guys are thinking of buying an apartment building or a strip center or an office complex, whatever it is, that Sean's company will jump in and come and give an estimate, in that. So so let me see if I can. George had a great question here. Besides having it done professionally, I understand there's some do-it-yourself online cost seg companies for small investors like myself. Unfortunately, couldn't afford a company. Can you talk about pros and cons? Okay. Give I mean, this is about like doing it yourself here, Sean, and I get you can. I got a buddy who's very, very smart finance guy, and he does all his own cost segs. I mean, it's not for the faint of heart from what I can tell.
Right.
But talk me through to help my man George out here with some
Yeah.
thoughts.
So
Great
George,
question,
that's a
George.
great
Thank you.
question. So we offer 2 different types of studies. We offer a detailed study, a detailed engineering study, and that means that's very granular. We're going to get every component out of the building and make sure that
Yeah.
we can get as much as possible into that bonus depreciation front loaded, right? We also offer a modeling study. So a modeling study is a much lower price point, right? And so it's a much more affordable. And we did that because there's kind of a gap in the market where people don't want to pay thousands of dollars for a single family home, right? But they still want the benefits of depreciation. So we have a modeling study, and that's really just a streamlined version of a cost segregation study. It's not as granular. We're looking for like the big ticket items, right? Like the appliances, the kitchen cabinets, things like that. But we're still, the goal of it is to get 80% of the depreciation benefit for maybe 20% of the price of a detailed cost segregation study.
All right.
So yeah, that's our goal there, is to help fill that gap. So
80/20
happy
rule.
to help
Hey,
you.
okay.
What's that?
Yeah. Yeah.
80-20 rule. Exactly.
Yeah, 80-20 rule. And bear in mind, guys, what you're going to do is you guys are going to take this engineering study and then you're going to consult with your CPA, which, the CPA is the other part of this equation, which we'll talk about. I know that's something that you and I can talk about as well on the CPA side. So let's talk about that in a second, Sean. But remember, guys, you're going to take this engineering report that's going to be broken down. You're going to give it to your CPA, who's going to then submit this report as part of certain forms for your tax forms and stuff like that. Your CPA is the third leg of this tricycle that you need to have involved here to get a cost seg done properly. And so for those watching, including you, George, consult with your CPA on how cost segs go, whether or not it's recommended, tell them the whole situation. And I think that a CPA would be a great team member to be involved in this. And great question, George. Sean, transitioning. Your company uses or has a means to tell us a little bit about the CPA and bookkeeping services that your company uses for doing stuff overseas. My company, DeRosa, has several overseas team members. Awesome. All of our team members are based in the Philippines, but they do everything from a social media stuff, social media marketing, YouTube content creation, all that stuff. But I've also heard of other firms, including yours, that are leveraging what I think to be well-educated folks, really great culture, that are now working. And, the folks that work for my company work US-based hours. They've made a joke that the Philippines is pretty much on the Eastern Standard Time now,
true, right?
As a country. Isn't that crazy? There's restaurants that are open at midnight, at midnight their time, noon our time, right?
Yep. It's a great country, great culture. Like, I love working with people from the Philippines. So I guess a little background, like, I'm a CPA myself, but I don't do tax work. So I don't have a tax firm. All I do is focus on the cost segregation side. So I think it is very important to implement your tax CPA into this, right? Like, what I do is when we do these studies, I give offer just a free call with the tax CPA so that we make sure we're on the same page.
Great.
Any questions, any back and forth, we can figure that out. And that adds benefit to me. I learn, and the tax CPAs learn as well. We do some overseas headhunting, overseas recruiting, right? And so when it comes to US, I think CPAs and just professionals in general, a lot of times, it's that 20% of the work is really where their value is, right? And so, like, actual tax prep and tax planning, I think, like, it's great to have a US tax CPA. Like, I highly recommend it. But then on the monthly bookkeeping side, right? We can go hire CPAs from the Philippines, CPAs from the Middle East, CPAs from other countries. In fact, I think they just opened it up in the Philippines where they can get the US CPA credentials, because usually when I say CPA, it's credentialed in their home country. Point being, is there's a lot of people out there in the world who the price point is way, much less, but they have experience maybe working for Big Four accounting, and they can help you out. So we do some headhunting where we go help people hire people from overseas, help US entrepreneurs, US business owners hire people from overseas. So for me personally, right, like, I have rental properties, I have self-storage facilities, and I was doing all of the tax work, all of the financial statements, everything myself in the beginning. And now I have it all built out in-house, but my team is made up of over 10 people from India, Philippines, Egypt, and we recruit all over, but we help other US entrepreneurs, other real estate investors go hire people overseas. So we have some options for that.
Is that set up like a consulting firm, or are you guys we've worked with a staffing agency that helped us hire our very, very beloved team members in the Philippines, right?
Yes.
We worked with the staffing agencies to help do that. So are you guys offering, is it like a staffing agent service, or is it like beyond that where it's, a little more white glove, or where are we?
So it's not so much white glove, like it's it's more of a staffing service. So it's more of the recruiting. So we're going out, basically think of it as a funnel. So, there are millions of people throughout the world, and there are people you can go on Upwork, Fiverr, things like that. The talent pool is much more limited there. most of the people, 95% of the people we hire aren't on those websites. So our goal is to go find you the right person who fits the role at the right like market value price. So we start out top of the funnel. We post job boards everywhere, nation or worldwide. We test English. We vet resumes. We do third party like skills like software skill testing, so we can test like financial analyst skills or whatever they say they have experience in. We can usually test it, and we narrow it down. And then we interview the people who are narrowed down, and we say, okay, we get down from like maybe 600 applicants on average down to like 3 to 5 applicants. We bring you those 3 to 5. You interview. No obligation. You don't have to. We require like a small deposit just to make sure you're serious about it, but it's refundable if you don't hire anyone. But the idea is to bring you the top candidates. You interview those candidates, and you say, yeah, like, okay, I want to hire this person. This is the right fit. Then we have some guarantees in terms of quality for retention and for just quality as well, making sure they truly are the right fit. And you can either hire them directly, right? We just take a fee for doing that, or we do like month to month. And so we're here to make sure like you have the right person. Just like a U.S. recruiter would go help a business here, hire here in the U.S. We're doing the same thing. We're just doing it overseas. So fill a lot of accounting roles, a lot of in-house accounting roles, because that's a big one that people don't really think about. So yeah, happy to help anyone who might need those
Guys,
services.
it's been something that was a game changer for DeRosa. So guys, go to mavensuccess.com/Matt. There is a link here in the show notes here. We'll make sure that it makes it over to the long form YouTube video that gets published to this interview as well. Mavensuccess.com/Matt. And so that our friend Sean here knows where the lead came from, so you guys can make sure that it came so that he knows that it came from when his conversation with your good buddy Matt here on the show. Guys, that really interesting. It's not, and I want to just underscore one more thing. It's not that we don't want to hire US based folks. Sean and I would both say that. I love my US based team. We have both, but sometimes for a application, it makes sense to hire someone from overseas, whether you just requires a different like mindset, skill set, whatever it is, or if you're a small business where every dollar matters and stuff like that. There is call it like a currency arbitrage that you win from when you're hiring overseas and everything like that. So these folks are paid great wages for their home country, and it's a win-win. And we really love US based focus and overseas focus too for hiring. And most companies are becoming multinational and global these days anyway. So
yeah, I think it's big for like especially entrepreneurs who are starting out, and even for myself, like I have self-storage facilities where it doesn't make sense to hire a third-party management company. It would just kill the cash flow on the deal, right? And like I can't manage it myself, otherwise I wouldn't be able to continue to grow, right? Or that would be my full-time focus. And that's something where it's like, okay, overseas person would make sense in this specific role for property management here, right? And so it's less of replacing everyone or just hiring overseas and more of leverage, that 80-20 leverage, right? Making sure you're maximizing the value of the people that you are hiring here in the US, and having a lot of the smaller things done, or other certain tasks that can be delegated to people overseas. And that's what we do. So I'll give, I just go to the mavensuccess.com/Matt, and then have a discount there for everybody, for just your show listeners. And
sweet. That's great. Hey guys, I didn't even know that Sean was gonna do that. Discount associated with you guys for listening today. So to get that discount, go to mavensuccess.com/Matt, and you guys can monetize that and maybe get some help in running your business, because we're only supposed to, as entrepreneurs. The way I grew was by doing only what I was great at, and that means I got to find people that are great at doing stuff that I'm not great at. And staffing agencies like Sean's are where to go to get a lot of that done. So, Sean, final thoughts? Anything else you want to bring home for cost seg, for CPA, bookkeeping conversations we talked about today, real estate market? Anything you want to throw in there for final thoughts?
Yeah, I did the same thing for mavencostseg.com/Matt. All the listeners just get a discount there too. So go there if you're interested in cost seg. Estimates are free. Keep in mind, like if you bought in the past, we can go back and look. Like so, if you bought a rental property 5 years ago, you didn't take that depreciation or that accelerated depreciation, we're able to help you out, and you can actually there's a form where you can actually have catch-up depreciation. So rather than going back and refiling 5 years, we can say, okay, here was the missed depreciation. Let's get it all on your current tax year. And that's called a Form 3115. So there's a lot of opportunity there. Happy to help you out. Happy to talk, see if a detailed study would be more beneficial or a modeling study.
And to throw one thing out there, guys, I've heard large cost seg outfits tell us that, oh, well, unless you spend more than $500,000 for the asset, cost seg's not going to make sense because of the cost of the study. Now, you could use Sean's service for the more macro view, not like the super granular study. My guess is, Sean, that the study that you said that costs about 20% of what a full blown cost seg would run you might be worth doing for somebody who's got a $200,000-$400,000 triplex or something like that. That they plan on holding for the foreseeable future. Guys, why not unlock a lot of those depreciation losses that you have sitting there for smaller assets? Sean, correct me if I'm wrong, but I think that could be a good play for a lot of our listeners here.
Yeah, no, exactly. That's the whole purpose of it. It's kind of a gap in the market where people aren't doing them, and we want to help you out and do those. So that'd be really good, and happy to talk to you. If you guys ever want to talk about short-term rental loophole or real estate professional status, anything like that.
That's a whole nother show, guys.
Happy to talk to you guys about it.
Guys, go to mavencostseg.com/Matt to hear more on all things. Sean, great having you here on DeRosa Insiders Live. Really appreciate the conversation. Guys, like I said before, it's not how much money you make, it's how much you get to keep. Bookkeeping services and CPA services are going to allow you to properly run your numbers so that you know what you're making and what you want to tell the IRS you made in a clear, concise, transparent fashion, so you can pay not a nickel more than what you owe. And also cost seg services are there for you guys to leverage the rules that are already there. We're not making these rules up. They already exist, and they're there for you as a real estate investor to take advantage of. Sean, thank you so much for joining us on the show today.
Thank you, Matt. Thanks for having me. I appreciate it.
Thanks. Guys, great conversation with Sean from Maven Cost Seg. Guys, go to mavencostseg.com/Matt or mavensuccess.com/Matt if you'd like to hear more. That's what we got for you today, guys. Just to recap, real estate multifamily market did have a little bit of a hiccup, little blip, 8.4% reduction in multifamily pricing as compared to last year. Does that mean that we're at the bottom? Guess what? I don't know. My crystal ball is broken, but I believe that means we're either at the bottom or very close to it. 8.4% is very significant for multifamily to drop in pricing over a year's time. So maybe it's time to put your buying shoes back on and get out there and take a look at some of the markets that you know and love, and get out there and do some networking, talk to some brokers, maybe make an offer. So what if it's not at asking? See what sticks, right? Great conversation with Sean as well from Maven Cost Seg. Guys, go and check out his company here to hear more about how they can help you save on taxes. It's legal to do so. Why not engage in conversations to not pay a nickel more in taxes than you should? Great episode today for DeRosa Insiders Live. Hope you guys join us next Tuesday at noon Eastern, where we will be here. Be sure you go to DeRosa Insiders on Facebook and join our very, very free community we have there. And if you guys want to pay just a few bucks per month to learn from DeRosa, including attending my office hours, we've got some surprise guests that are coming to our accelerator program. We're bringing in some folks, some other vendors, some folks to come meet with our thriving students that are out there buying apartment buildings, doing deals right now. That's what's happening in our accelerator community. You want to be one of those folks that are out there doing deals with DeRosa's oversight and mentorship. Go to DeRosaGroup.com/accelerator. We want more folks that are looking to grow their multifamily businesses as a part of our community. And it's priced at just a couple of $100 per month. If you want to be the lowest price tier is there. And you guys get direct access to me and the DeRosa team. DeRosaGroup.com/accelerator. What are you waiting for? See you guys there. All right, guys. I'll see you next week on Insiders Live. Appreciate your time today. Have a great day.